Now let's focus on the 50-year mortgage. That's where all these conversations are really coming up. And this is where it gets a little tricky because the logic would suggest on a 50-year mortgage, interest rate has to be more. 50-year mortgages. We're hearing all about it, right? It's the best idea yet. Is it a bad idea? Well, it could be a great idea, actually, if you understand how it works. Now, first you have to understand the genesis of a 50-year mortgage. As we know that mortgages are typically 15 to 30 years. That's the most classic case. So we have to understand the numbers, and this whole concept is based on numbers. So I love the idea because it makes all the sense in the world. So when you take a look at, let's just say, a $500,000 house, you focus on 20% down, which is a traditional way to buy a house. That means you put $100,000 down. That's like the first hurdle. But that leaves you with $400,000. Now, you could be buying a $430,000 place with $30,000 down. This whole math that I'm going to be talking about today is based on a $400,000 mortgage. So let's unpack why it's amazing. The first part is looking at a 15-year mortgage versus a 30-year mortgage. The 15-year mortgage will always be a lower rate than a 30-year mortgage. Why? You're less risk to the bank. They get their money back sooner. And everything in investing is less risk equals less return. So when you factor in the 5.5% at 15 years, at a $400,000 mortgage, that is $3,268 a month. Now that's total payments over that 15-year period of $588,240. That's principal and interest. Well, if you only borrowed at $400,000, that leaves you paying $188,240 of interest. Now that's at 5.5%. When you do a 30-year mortgage, you're not going to get a 5.5%. They're going to charge you more interest. So it might be a 6% rate. Well, on a 30-year mortgage, that payment is $2,398. Now that's a total principal of interest payment of $863,000, which means you're paying double of what you borrowed on. You borrowed $400,000, but the interest payments were $463,000 throughout your lifetime. Now that sounds terrible, right? Now let's focus on the 50-year mortgage. That's where all these conversations are really coming up. And this is where it gets a little tricky because the logic would suggest on a 50-year mortgage, interest rate has to be more. So if a 15-year mortgage is 5.5%, if a 30-year mortgage is 6%, let's just say if a 50-year mortgage was 8%, that means your payments are $2,717. That's actually more than a 30-year mortgage. So it can't be 8%. Because, by the way, if that was the case, you would be paying over $1.6 million. And by the way, if in fact their interest payments would be 8%, a 50-year mortgage would be $2,717. Here's where the math gets tricky. At 8% for a 50-year mortgage, your mortgage payment is $2,717. Guys, that's more than the 30-year mortgage at 6%. So I can't imagine our government's going to do that. That's total principal and interest payments of over $1.6 million and interest alone of $1.2 million. Okay, well, let's look at it at 7%. It's $2,406 a month. Yet again, that's principal and interest payments of over $1.4 million. Interest alone, you're paying over $1 million. Even then, it's still slightly more than the 30-year mortgage. So the only way this would really make sense if it's at, let's call it 6%, which means it really disincentivizes people. Why would you do a 30-year mortgage if you can do a 50-year mortgage at 6%? Well, your answer might be because you pay more in interest. Because your mortgage payment is $2,105, which is a total principal and interest payments of over $1.2 million, $1,263,000 to be exact. You are going to be paying interest of $863,000 throughout your lifetime. That's an extra $400,000 of interest. Sounds like a lot. But now you have to look at the compound growth of 6% when you're looking at a 30-year versus a 50-year mortgage. If you were earning 6% the whole time, excluding any tax write-offs and benefits that you may be getting, you would earn as much in investing return as you would in interest paid. Yet again, excluding the tax benefits. That is including the extra $293 a month that you save from doing a 50-year mortgage versus a 30-year mortgage. Now, over 30 years, at 6% growth, investing that dollar amount, you would have $294,000 after 30 years. Now, here's where it gets interesting. You would have $294,000 in your investment account at that time. So literally, it's a wash. It's a break even. Now, 50 years would be at $1.1 million. That's at a 6% return. Now, the S&P 500 has averaged more than 10% since 1926. But let's assume you can earn more like 8% a year on your money. It now becomes more of a no-brainer because you're borrowing money at 6% and earning 8%. Now, you stretch that out over 50 years, and you now have so much more money. At 8%, you'll have $2.323 million. That's almost $1.5 million more money that you would make by understanding, utilizing, and capitalizing on your mortgage debt. That's what we call smart money. Also, you can always refinance if rates go down, which helps the math even more. Now, here's some interesting facts on home ownership. The first one is, according to the 2024 report by Redfin, the typical median U.S. homeowner stayed in their home about 11.8 years in 2024. So why does it even matter us talking a 30-year versus a 50-year mortgage if the average person stays in their home less than 12 years? Why is 30 years extremely uncommon? Well, since the median stay is 12 years, by definition, half of the owners move before 12 years. Thus, staying 30 years is well beyond the typical endpoint. And if 40%, the reason staying in a home for 30 years is so uncommon, well, you have to look at the numbers. If you have the median stay is roughly 12 years, by definition, half of the owners move before the 12-year mark. Thus, staying 30 years in your house is well beyond the typical endpoint. And if roughly 40% of boomers have at least 20 years, then the share of reaching 30 years must be significantly lower, likely single-digit percentages. We simply just don't have the public data showing. So what does this all mean? So the important part of a home is what? That your house appreciates with or without your mortgage. So the growth happens on the appreciation of what you purchased it for. So if you paid off your mortgage, your home goes up with or without the mortgage. The value increases. So the 30-year versus 50-year argument doesn't really make much sense. And I'll take it a step further. If you really wanted to pay it off in 30 years, make the extra payments treating it like a 30-year mortgage. If it's the same interest rate, you'll pay it off in exactly the same time. Now, for those of you who like 15-year mortgages, well, if you really wanted to pay it off quickly, treat your 30-year mortgage or your 50-year mortgage like a 15-year mortgage. Pay that substantial extra payment. Now remember, in the example I gave earlier, it's roughly 0.5% lower interest rate if you had a 15-year mortgage. Why is this important? Well, it's because that you can't pay it off in 15 years because it's a lower rate. But you want to know how fast you'll pay it off? A 15-year mortgage is 180 months. A 30-year mortgage is 360 months. You'll pay it off in 189 months. You only lose 9 months out of 30 years, but you've given yourself 30 years of flexibility. That could be if, God forbid, there's a loss of job, a disability, a death, or just an emergency that comes up. You've given yourself 30 years of flexibility and you only lost 9 months. The irony is, if you in fact wanted to go to the bank, if something happened and said, you know, I have a 15-year mortgage, can you treat it like a 30-year? They're going to tell you to get lost because they won't approve you anymore during the underwriting. That's the messed up part about finances. So that's a lot of pros, right? So now we have to talk about the cons of this 50-year mortgage. Number one, the undisciplined won't save. They just won't save that extra $293 in my example. Well, the problem with that is they are in fact going to be paying an extra $400,000 plus of interest, which is terrible. So you have to be very smart to do this, very disciplined to do this, and quite frankly, you should have a financial help to make sure you're doing the right things. And this 50-year concept of a mortgage is not new. They had this back in 2006 and 2007 through companies like Bank of America. Why did they get rid of it? Well, because through the Dodd-Frank Act, a lot of mortgage lenders were being looked at as taking advantage of borrowers, not knowing what they were signing up for. And so they were just selling them the highest mortgage they can possibly afford, which leads to number 2. Home costs won't be coming down because, in fact, that if you have a mortgage that you can now afford a more expensive home, well, costs are not going to come down. If you can only afford $2,200 a month, you might be only able to buy a $400,000 home. But if you stretch it over 50 years, they might say you can now afford more, which is logical because the monthly payments dropped by over 10%, almost 15% in those previous examples that I shared. So the cost of homes will continue to go up, which means the cost of property taxes also go up, which is my number 3. Property taxes are linked to the value of the home. Well, if they keep going up because more people are buying because now more people can afford, that becomes an issue. Lastly, the same logic, number 4, is insurance costs will continue to rise. As if the cost of homes continue to increase, the rebuilding costs are even more expensive. So everything matters in this. And home inflation isn't just controlling, home inflation is no longer in control if it continues to keep growing. So hopefully, this is the reality of what I call home inflation. So you have to understand your situation, what you can afford, and understand the value of compound interest. It pays to go not only a 50-year mortgage, I would be more of a benefactor, I would be more of a supporter, so you guys know to break that up. I would be more of a supporter for you to have a 100-year mortgage. And you want to know why 30 years is so popular? Our IRS deemed it was popular when the IRS deemed it was appropriate as a depreciation on a residential home is 27 and a half years. This is why the mortgage companies like 30-year mortgages, because it's logical. It's what the IRS says is what the lifespan of a home is without any major remodels. So when you take a look at the benefits of a 50-year mortgage, in my opinion, it's the best idea possible. It's why people should be taking advantage of this, and it's why you should really be looking at this as a positive. It gives you more flexibility, it lowers your payments, but please, please, please make sure you are staying disciplined and that you're doing the right thing to put your financial situation in the positive. And if you need more help with that, please take a look at the next video, as we always like to give you more encouraging news to increase your financial situation.